This time, we talk Bitcoin. But as always, for those new to the channel, please consider subscribing, and for those that find value, please hit the like button. We usually review trading or investing strategies from some of the most well-known experts, but this time, however, we look at how I use many of the principles covered to trade Bitcoin, and how I traded Bitcoin from 2016 to today, through bull and bear markets, and how I intend to trade this next phase and beyond, with, of course, good risk management. Before we look at the strategy in detail, let's first summarize the results from 2016 through to today. I took 12 trades in total, starting from November 2016 through to today. I either took a cash position or I took a long position on Bitcoin. The results of each trade can be seen here, ranging from a maximum gain of 241% to a maximum loss of just under 15%, whilst my last trade was closed today. To put these results into perspective, a $10,000 investment compounded against each of the 11 trades would have returned just over $1.3 million. Personally, I rebalanced my portfolio as my trading account grew, whilst seeing more moderate equity growth. A buy and hold strategy, on the other hand, would have seen the same $10,000 grow to just over $450,000, but with an astonishing 84% drawdown along the way. Not forgetting that buy and hold would have seen you fully invested for over 1,500 days, resulting in opportunity cost, whereas my strategy would have seen you invested for just 680 days. The strategy is rather simple, leaning on the principles of momentum, price action, and solid risk management. The key component that I apply to Bitcoin and my bread and butter strategy is the MACD indicator. However, due to the volatility of Bitcoin, I use a variation to reduce risk. I refer to it as dual MACD. The purpose of this video, however, is not to dig deep into the methodology of the indicator, but rather see its application against the price of Bitcoin in conjunction with other criteria. In summary, MACD stands for Moving Average Convergence Divergence. Simply put, it is a trend-following momentum indicator, which measures the relationship between two moving averages. It is calculated by subtracting the 26-period exponential moving average from the 12-period exponential moving average. This creates the MACD line. A 9-day exponential moving average is then plotted over the MACD line. This is called the signal line. The most common use amongst traders looking to buy a position or go long would be when the MACD line crosses above the signal line, and this crossover is seen as a bullish signal. This is the same signal I use to trade Bitcoin, although I use the combination of the daily time frame and the weekly time frame, hence the name dual momentum. Let us look at my method and the signals generated. First, I look at the weekly Bitcoin chart and then add the MACD indicator. Using the weekly chart of Bitcoin, we can see how the MACD line crossed above the signal line. This is when I made my first Bitcoin trade back in November 2016. This crossing marks the beginning of a trading window. The trading window will remain open for Bitcoin so long as the MACD line remains above the signal line on the weekly chart. The entry trade was made here, the opening of the week and the week after the MACD line crossed and closed above the signal line. Step 2 is therefore buying at the crossover. Step 3. Once in the position, we now open the daily Bitcoin price chart and once again add the MACD indicator. This time we wait for the MACD line to cross below the signal line, and at this moment, many traders would sell. However, we use the price action of the closing candle to make a stop-loss position. We can see the closing candle here, and it is at this point we enter a stop position, directly at the base of the candle wick. The following few days see the price hit the stop-loss, and we are therefore taken out of our position. The following 2 weeks we see a sideways consolidation of price, but we wait for the crossover of the MACD line before re-entering our long position. We eventually see the crossover here, but before we confirm our re-entry, we need to ensure the MACD on the weekly chart remains above the signal line. We get confirmation, return to the daily chart, and re-enter our long position. The key takeaway at this stage is the reduction of risk. By placing the stop loss at a retracement of momentum, like we did here, we eliminate any unknown drawdown. Let us assume we see the price of Bitcoin continues to drift to here, but almost like paying an insurance premium, we do not suffer any further loss. The cost of our insurance premium can be considered the difference between the exit price and the re-entry price. In this example, the premium we paid for risk reduction was around 10%. It's a similar concept to risk and reward, but in reverse. We risk losing out on a 10% gain in price, but save ourselves from considerable drawdown. We continue the same process as the price progresses, again with a keen eye on the MACD crossover. Remember, we're still looking at the daily chart. We see the cross down here, and once again place the stop loss underneath the wick of the closing candle. We're taken out of the position the following day and stay in cash, awaiting the next crossover above the signal line. We see the cross above here, and once we confirm the weekly MACD is still above the signal line, we take another long position. Notice how the cost of our insurance premium paid for this position was almost zero, due to the stop loss price being very close to the re-entry price. I followed and continue to follow this mechanical concept through to today. Its principle is simple. The weekly MACD ensures we have long-term momentum in our favour, and the daily MACD ensures the short-term momentum movements, aligned to the weekly window, help us maintain excellent risk management. By following this simple dual MACD concept, you can ignore all the hype and commentary surrounding Bitcoin and just follow the momentum. Let's look at the strategy through the previous Bitcoin bubble through to today. Here we can see the previous Bitcoin peak on the weekly chart, almost touching 20,000. We can also see the trading window which took us through the peak of the bubble, through to the downward crossing of the weekly MACD. But remember, this is just a window. We use the daily chart to determine the exit and entry points. The daily MACD indicator would have had us exit the trade much nearer the peak. If we look at the daily chart portion leading up to the peak, we can see the daily MACD remained above the signal line, and therefore we would have remained in the ascent at this point. Now let us look at the exit point during the bubble, determined by the daily MACD. We can see the peak here at 20,000, and just 3 days later the daily MACD crossed below the signal line. Just as we did before, we look for the lowest point of the closing candle and place the stop loss at the base of the wick. The following day, price crossed below our stop loss, and we exited our position at just over 15,000. Zooming back out to the weekly chart, our 15,000 exit trade would have been here, leaving us in a cash position throughout the following months of price declines, all the way down to almost 6,000. The next window of opportunity came here, as the weekly MACD crosses back above the signal line. I had only been presented with one trade during this window based on the daily MACD crossover, and this was on the 24th of September, at a price of 6,700. The daily MACD then crossed back down on the 14th of November at a price of 6,200, equating to a loss of 7.6%. Our next trading window began here in February of 2019. This begins a series of trading windows leading up to today, the 17th of January 2021. Remember, each window is determined by the weekly MACD line being above the signal line. In the first trading window, I took a long position on the 8th of February 2019 and exited the trade on the 15th of July for a 214% return. The next trade saw an entry on the 6th of August and an exit on the 15th of August for a loss of 14.7%. A quick glance at this losing trade on the daily chart. We can see the MACD cross above, our entry point, and a few days later the MACD crossed down. We put our stop loss at the base of the wick, and shortly after we were taken out of our position. In the second trading window, I had a gain of 30.2%, and in the third, I took a return of 24.2%. In the current trading window, in which I closed my position today, I had a gain of 217%. Again, a quick glance at the rationale for closing the position, determined by the daily chart, we can see the MACD cross down and we place our stop loss below the wick of the closing candle. Today the price crossed below the stop loss, and we entered a cash position and a way to cross back up to re-enter a long trade. The theory behind the strategy is that markets tend to trend up slower than they do coming down, and therefore we use the slower moving weekly MACD on the long side and the faster moving daily MACD on the sell side. A simple, highly effective momentum strategy that I use specifically for Bitcoin to generate excellent results. Remember, ignore the commentators and follow the money. Thanks for listening, and as always, please hit the like button, consider subscribing, and join our community below.